This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Triple header, the Dow, the Nasdaq, and the S&P 500 all close at records as corporate earnings help drive the big rally.
Tune in. Two media companies with familiar television networks are reportedly in talks to combine to increase their clout in a fast-changing entertainment industry.
Retirement insecurity. Americans are losing faith in their financial futures, but there are some things you can do to change that. Those stories and more tonight on Nightly Business Report for Wednesday, July 19th.
Good evening, everyone, and welcome. The blue chip Dow Index joined the S&P 500 and the Nasdaq in record territory. Corporate America's quarterly results seemed reason enough for investors to buy up stocks. And as one investment strategist put it, last year we saw an earnings recession. Now we have consecutive quarters of earnings growth. As profits grow, so do their stock prices in theory, and companies increase their investments and their hiring. Today, the Dow Jones Industrial Average added 66 points to 21,640. The Nasdaq gained 40, and the S&P 500 rose 13.
A lot of corporate news today came from the media industry, which is changing very rapidly. Scripps, the parent company of HGTV and the Food Network, reportedly is holding discussions about selling itself to Discovery Communications. According to the Wall Street Journal, terms of the deal not known, and there is no guarantee that an agreement will be reached. The two have discussed a tie-up before, but abandoned talks in 2014. Experts say the two companies are trying to chart a new course in an evolving sector. And in an interview yesterday, before these reports surfaced, the CEO of Discovery said there's an immediate need to be relevant.
We have a choice. So we can hold on to our existing business or try and do some of these new forms of content, or we could figure out how to disrupt ourselves. The question is not how much money. The question is, can we be relevant on all platforms? And if we are, then we will be rewarded by shareholders.
The report sent shares of both Scripps and Discovery higher. Viacom also rose on a Reuters report that it may be interested in Scripps.
To see how the media industry is changing, look no further than today's announcement that NBC News is launching a twice-daily news show on Snapchat. The show will have morning and afternoon editions each weekday and one on the weekends, and will be about 3 minutes in length. The show aims to connect with viewers who no longer get their news from traditional television. NBC Universal invested $500 million in Snap's IPO earlier this year, and NBC Universal is the parent company of CNBC, which produces this program.
The entertainment business could undergo even more changes if one media veteran has his way. Julia Boorstin takes a look at Jeffrey Katzenberg's plan to revolutionize television.
Media mogul Jeffrey Katzenberg has an ambitious plan to reinvent TV for mobile devices and mobile viewers. He's calling it New TV, original video series with episodes 10 minutes and less, covering everything that's on TV, news and sports to sitcoms and reality shows. But what makes New TV totally different is that the production costs, and therefore the quality, will be in line with top-tier TV costs, as much as $125,000 per minute, more than 10 times what's traditionally spent on digital content. And with those higher budgets, Katzenberg says he has top Hollywood showrunners on board, such as J.J. Abrams, Mark Burnett, Jerry Bruckheimer, and Ron Howard. And Katzenberg tells me he'll be able to license custom content from all the top media companies, including Disney, Fox, CBS, and Lionsgate, by paying TV-level fees and enabling creators to own long-term content rights. Katzenberg says it will take at least $2 billion to launch the service. So he tells me he's in active talks with all the major platforms to find a distribution partner who may also help fund the service. Based on the meetings Katzenberg had in Sun Valley and my understanding of the interested players, that includes Apple, Google, AT&T, Verizon, T-Mobile, Snapchat, and Spotify. That distribution partner will help determine the final business model, presumably a free version with ads and a premium version for a subscription fee. This idea would sound impossible coming from pretty much anyone else, but Katzenberg's 4-decade track record in Hollywood, including his decade running Walt Disney Studios and his role as CEO of DreamWorks Animation, that and his close relationships with the media giants mean his bold vision has a real shot. For Nightly Business Report, I'm Julia Boorstin in Los Angeles.
And there is a big reason why these media executives want to make changes or create new tie-ups. According to one estimate, cable TV is expected to lose more than 1 million subscribers in the latest quarter. If true, it would be the first quarter in which pay TV net losses exceeded the 1 million mark. The second quarter is historically weak, but the industry is also facing new competition from streaming services like Netflix, Hulu, and YouTube.
Let's talk a little bit more about the current state of television and where it may be headed. Thomas Egan covers the industry for the Telsey Advisory Group. Mr. Egan, welcome. Let's start with this possibility of a merger between Discovery and Scripps. We heard earlier David Zaslav, the CEO of Discovery, say that whatever happens in the TV business, ultimately, after consolidation, the winners are going to be the ones who are relevant digitally and who come up with new products for the digital multi-platform era. Do you agree with that?
Well, I think there's something to that. So, I mean, today, the networks have to follow where the viewers are, and viewers are on mobile, and as you probably know, ratings don't reflect that. So most networks aren't being paid adequately for all that mobile viewership. So, I think this deal is very interesting. I think, although we're not a huge believer in massive content consolidation, this deal is different. And one of the reasons why to us is because their brands resonate so well together. We wouldn't be surprised if the two companies roll out some kind of lifestyle culture skinny bundle. They could put all their networks into one bundle for about $10.
You say you're not a big fan of large content combinations. Why is that? Because it seems as though the content is king.
Well, because it's different than on the cable side. On the cable distribution side, remember that 40% of their costs are just program costs. So if they can reduce those costs by Charter buying Time Warner Cable, that makes a lot of sense. You don't reduce your program costs by getting bigger. So think about, the biggest media company doesn't have the lowest costs. And conversely, AMC, which was the smallest media company, has some of the biggest hits.
So here are two companies that have some well-known network brands, Travel Channel, Discovery, Home and Garden Television. The idea here is that they could create a sort of mini bundle that they would sell through whom and to whom for what kind of price?
Well, again, I think what we're hearing from consumers and from the operators is they're trying to find a skinny bundle, and not all of them are successful. But I bet if you put their channels together, you could corner the market on lifestyle, culture, and science, and probably price it at about $10.
One of the issues has been, as you just mentioned, the measurement or lack thereof on mobile devices, which of course then impacts the ad revenue because there's no way to chart that if you can't get a reasonable kind of measurement. Right. When do you see that changing with the likes of Nielsen?
Yeah, well, we are hold rated on a lot of the programmers right now because the affiliate fees are kind of flat to down a little bit, and the ad revenue is flat because, as you're saying, Sue, ratings are down. We think some of that does change in 2018 and 19 as more of the programmers use the total platform measurement out of Nielsen and other methods out of ComScore.
All right, Thomas, thank you very much. We appreciate your time tonight. Thomas Egan with Telsey Advisory Group.
And still ahead, companies charge them and you pay them all those fees, and they don't appear to be going away anytime soon. $32 million Americans would lose their health insurance under a Senate plan to repeal the Affordable Care Act. This is according to analysis by the nonpartisan Congressional Budget Office. The number of uninsured would rise by 17 million next year.
Well, the Supreme Court gave the president a win and a loss today on his travel ban. In the win column, the justices said the administration could move ahead with plans to impose travel restrictions on a broad group of refugees from certain countries. But in a setback for the president, the court ruled that extended family members, including grandparents, aunts, uncles of U.S. residents, could continue to travel here and were exempt from the ban. The administration had argued that such extended family was not a close enough relationship to meet the court's, quote, close connection standard. The court set oral arguments in the case for October 10.
Well, it looks like we may have a timetable for tax reform. In a radio interview today, Speaker Paul Ryan said the House will start drafting legislation to overhaul the nation's tax code when Congress returns from its summer break. Mr. Ryan's comments come as a House panel debates the Republican budget plan, which was released yesterday and is the stepping stone for any tax reform.
And meantime, there's a timetable as well for the first round of talks to rework the North American Free Trade Agreement, better known as NAFTA. The U.S., Mexico, and Canada will meet in Washington starting the week of August 16th, and at stake about $1 trillion worth of trade between the countries. Reuters said the nations have agreed to an expedited time frame of 7 rounds of talks at 3-week intervals in order to avoid next year's Mexican presidential election.
Talks between the world's 2 biggest economies may have gotten off to a bit of a rocky start. Leaders from the U.S. and China are meeting to discuss some thorny issues like trade, but also jobs. And with tensions already high, the talks got underway during day 3 of the White House's Made in America Week. Kayla Tausche has our report.
President Trump campaigned on getting tough on trade, and today he highlighted counterfeits at a roundtable with CEOs of small businesses that make coasters, gutters, and pillows here in the United States.
From day one, my administration has been fighting to bring back our manufacturing jobs and to crack down on foreign countries that cheat. Get a lot of them. We will end the theft of American prosperity, and we will stand up for our companies, our factories, and our workers.
At the same time, Treasury Secretary Mnuchin and Commerce Secretary Ross hosted a Chinese delegation as part of the 2 countries' comprehensive economic dialogue. A key issue, the U.S. trade deficit with China, which stands at $138 billion so far this year.
China now accounts for nearly 50% of the U.S. goods trade deficit. If this was just the natural product of free market forces, we could understand it, but it's not.
Chinese Vice Premier Wang stressed cooperation as the country's economic talks enter their 12th year.
Dialogue cannot immediately address all differences, but confrontation will immediately damage the interests of both.
It's unclear exactly how the talks have proceeded or whether they've broken down over a specific issue. Planned press conferences to be held by each country were canceled within hours of when they were scheduled to take place.
I think the Chinese thought this was going to be a meeting to establish a plan for addressing issues over the next year. I think the U.S. came to this meeting expecting bigger concessions from China sooner than the Chinese wanted.
And one issue in particular the U.S. plans to pursue soon, a decision on whether to slap tariffs on Chinese steel and aluminum imports to the U.S. For Nightly Business Report, I'm Kayla Tausche, Washington.
Profit slips at American Express, and that is where we begin tonight's market focus. The credit card company said the drop, which was smaller than expected, was partly because of an increase in spending to attract new customers and hold on to existing ones. Revenue saw a slight gain, and those results topped analyst targets. Shares in initial after-hours trading fell, but they ended the regular day up fractionally at $85.93. And Morgan Stanley said strong performance from its wealth management business helped the bank report earnings and revenue that surpassed estimates. The bank did see a drop in bond trading, but unlike its rivals who already reported this week or last, the fall was more modest. Morgan Stanley shares rose more than 3% to $46.62. The spice maker McCormick will buy the food division of the British consumer goods company Reckitt Benckiser Group for more than $4 billion. In the deal, McCormick will add French's mustard and Frank's Red Hot hot sauce to its portfolio. McCormick shares were off 5% to $92.07. And despite posting a drop in earnings, industrial distributor W.W. Grainger still managed to top profit expectations. Revenue in line with estimates. The company also reaffirmed its guidance for 2017, and its CFO is retiring at the end of the year. Grainger down 7%, $162.19.
T-Mobile posted earnings and sales that were well ahead of estimates as that telecom giant added more phone subscribers who pay a monthly bill. The company also expects that strength to continue, and it raised its forecast for postpaid customer additions. Shares initially rose in after-hours trading and also finished the regular day up nearly 1% to $61.97. Higher costs caused asset management firm Northern Trust to report earnings and revenue that came up short. The company also said it would establish a European Union banking base in Luxembourg ahead of Britain's official departure from the EU. Northern Trust shares fell more than 8% to 89.21. And Select Energy Services, which provides water management to the oil and gas industry, is merging with privately held rival Rock Water Energy Solutions. It's an all-stock deal worth nearly $500 million. Shares of Select Energy Services soared almost 20% to $14.92.
United Airlines beat earnings estimates and saw profit and revenue grow, as we reported yesterday. But its revenue outlook is weighing on shares this day. The carrier caught off guard by excess capacity in their Pacific routes, but the CEO says the airline is not off track.
With regards to third quarter guidance, again, I think United is firmly, and I mean firmly, on the right path, and a quarter does not make a difference. The simple difference is others have guided a little higher. Part of it is that they're cycling some issues, some negative issues from last year, and then it's a forecast, and so we'll see as the quarter develops.
United fell nearly 6% today.
And United generates a lot of its revenue from fees, the most of any airline. But United isn't alone. A new report from IdeaWorks shows that the top 10 airlines worldwide generate nearly half of their annual sales from those types of fees, indicating there's a strong demand to pay extras for things like priority boarding, better seats, and upgrades.
Well, the United Kingdom just made it illegal to charge customers a fee to use a credit card. The fees, which can run as high as 20%, will be banned in that country starting in January. A British Treasury official says these charges can add up for customers, but critics of the move say banning surcharges will simply lead businesses to raise their prices to cover the lost revenue. In the U.S., a handful of states prohibit merchants from imposing specific credit card surcharges.
So as some companies pile on those additional consumer fees and others work to remove them, what can we expect to see from more businesses over time? Will they become more reliant on these fees or not? Here to discuss that is KPMG's chief economist, Constance Hunter. Welcome. It's nice to have you with us, Ms. Hunter.
Oh, thank you. It's great to be here.
Do you think that businesses, I mean, I'd like to think that they would be less reliant and we wouldn't get more fees, but I think that's wishful thinking.
Well, yeah, economists have been studying this for a while, and the concern, of course, is that it reduces competitiveness and that it tricks people into buying things that they wouldn't otherwise buy because they think the price is lower. And the real crux of the matter hinges on whether those fees are mandatory or optional. Now, there is some competition that's pushing down fees. So you mentioned T-Mobile earlier. You may be aware of T-Mobile's ad. It's a little girl with a lemonade stand, and it's costs $1, but people walk up and she says, oh, that'll be $2.80. And they say, well, why is that? And then she lists all the fees, and then it's an advertisement for a fixed price phone service. And you can see that that drew more customers to T-Mobile in this most recent quarter. So there is competitive pressure in the marketplace, but the problem is that when you look at airlines, for example, if you look at total revenues, these types of fees can be anywhere from 2 to 9% of total revenues, and those that are charging less are often competing on the basis of we're not going to charge you the extra fees. Right. But airlines aren't the only industry. I mean, for example, there's hotels. 16% of their revenues in 2016 were from hidden fees and mandatory resort charges. So this is something that's rampant everywhere.
I think the difference, as you point out, Constance, is the idea that some of these fees are mandatory and unavoidable. A resort charge, even if you're not going to use the resort, all you're going to do is go to the hotel. But businesses
or
have
if you don't know about it in advance and then you're stuck at the checkout and you have to pay it.
Or, what it seems to me businesses have been able to do is they've learned how to fillet the customer really masterfully. Particularly the airlines know that. When can you fight a fee and get it reversed?
Well, that I'm not an expert in, but what I am an expert in is whether or not this hampers competitiveness or not. And there's a lot of economic research which suggests that it does hamper competitiveness. And so what you're going to see is more governments examining this. So there's already some bodies in the U.S. that are beginning to examine certain aspects of these fees and whether or not they should be listed up front. So there's some regulations now from the FTC saying that, or I'm sorry, from the airline regulatory body that says you know, you got to list these things up front before the person buys the ticket, so then they can properly compare across different airlines.
Very quickly.
So I think you'll see more regulation.
Very quickly, though, are you surprised that the airlines, United is the number one, that they generate so much of their money, of their bottom line, just from fees? I was surprised by that.
Well, I think the study that you sent me, I interpreted it a little differently when I looked at their total revenues. So as I said, it's 2 to 9% from the specific unintended fees that they receive in revenues. And when you compare it to another industry, for example, like hotels, they're receiving 16% of their revenues from these unintended fees. So the report that you sent, one of the things they talked about was fees from other sources, such as partnerships with mileage and stuff. So if you break it down just into the hidden fees that the customer pays, that's a much lower amount, but it's still something that I think there'll be a backlash against.
Constance, thank you very much. Constance Hunter with KPMG.
Tell us about your least favorite fees on our website,
Yes,
npr.com. Write us. Coming up, whether you're a millennial, a mid-career person, an older worker like me, there are things you can do to feel, not you, more secure about your retirement. Americans are feeling less secure about their retirement. A new survey shows that the U.S. is falling further behind other countries. The U.S. didn't even crack the top 15. It came in at number 17, slipping 3 notches from last year. European nations dominate the top spots. Norway, where my forebears come from, number 1. Switzerland, number 2. Iceland and Sweden are 3 and 4. The countries that ranked the best benefited from strong social programs, accessible health care, and low levels of income inequality.
Here at home, millennials may be hurting their retirement security. A new survey shows the risk-averse group isn't as willing as previous generations to invest in the stock market, and that could be costing them financially over the long term. We took our cameras to find out what you think, and many of you agreed.
I see it as kind of like gambling when it comes to stock markets because it's unpredictable and you don't know. That's why it's something that I don't really look into or anything like that.
You definitely don't want to put your money away and then all of a sudden you hear that the market crashed and your money goes into wherever. I don't think I would trust it at all.
Right now, because I'm at the earlier stage of investing for my retirement, I'm okay with doing a riskier investment now that'll ultimately level out over time. And that's how my 401k is set up right now, is a little bit higher percentage on the riskier stocks.
According to NerdWallet, millennials who put their savings just in a bank account or under the mattress will end up 40 years later with $3 to $4 million less than if they had invested in the stock market.
All right, here to talk about what you can do to feel more secure about your retirement, no matter your age, is Ariel O'Shea. She's the investing and retirement specialist with the personal finance website NerdWallet. We're going to nerd out here, Ariel. It's going to be fun. Let's go sort of age group by age group to tell me the kinds of things that you advise people to do to grab their retirement savings by the throat and start going. Let's start with the start out people, the millennials, aged 22 to 35 or so.
Sure. So when you're first starting out, the most important thing you can do is get an employer match if you have a 401k at work. So that's free money. You want to take advantage of it. Your employer will match your contributions as long as you're contributing to that plan. And then once you've done that, you can consider contributing elsewhere. So an individual retirement account is a great option. A Roth IRA in particular is often great for younger workers. And they really have a long time for their money to grow.
Now, we have some other tips on the screen. Don't let student loans push off your retirement savings, et cetera. Now, let's go forward to tips for people at the midpoint of their career. And you say put savings for retirement above almost any other goal.
Yeah, so there are a lot of competing priorities at the midpoint of your career. You may feel compelled to start saving for your children's college, for instance. That's a problem for many parents. You feel like you need to put your children above yourself. But really, retirement comes first. There's not financial aid for retirement, and there are a lot of resources for your children's college. The other thing is that, you may be seeing a lot of raises, and raises are a great opportunity to put more money away from retirement. Every time you get a raise, you should put a little bit extra in your 401k, boost your contribution rate, ramp up your IRA savings if you can. That's a great way to sort of increase your savings.
I've often heard the same thing, that if you can't bank your entire raise for savings this year because you need the capital, try and bank half of it. Or try and increase the amount that you put into your retirement savings by 1 percentage point every year. That way you'll get up to where you need to go. Let's say you're in my, we'll call it more experienced demographic.
Seasoned.
With seasoned demographic. I've got 10 years or so until I might retire. What should I be doing? Quickly.
Well, you get the benefit of saving a little bit more. So 401ks have catch-up contributions. You get to save an extra $6,000 a year if you're 50 or older. IRAs have a similar catch-up. You get to save an extra $1,000 if you're 50 or older. So that's a great time to really buckle down and ramp up your savings efforts. It's also important to remain invested. A retirement time horizon doesn't stop when you get to retirement. You still need your money to continue to grow for 20, maybe 30 years, and so you don't want to stop investing right when you hit retirement.
I'm hoping it's going to grow for 20, 30, 40 years. Thanks, Ariel. Ariel O'Shea with Nerd Wallet.
Sure, thank you.
It will.
I hope so.
It certainly will. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everyone. Everybody, get saving. We'll see you tomorrow.
Yeah.